Okay. All right. There we go. Sorry about that. Welcome. Episode 109. Welcome to Champagne, France. I am obviously in a different location here. Figured it'd be a shame to waste the good view. My wife and I are on vacation, but traveled with a little bit of video equipment, just a little cheapy setup. Hopefully this works. I've never actually used it, but got a little webcam and, different microphone, but think we're all good. So yeah, my wife and I will be here for a couple of weeks and no schedule really. We just kind of book all the wine tours and every day is a little bit different. Sometimes we'll eat dinner. Sometimes we're just, probably had too much to drink. We'll just head back. So anytime I can just get an hour or so, I can hop on. I haven't planned anything, so we'll do a super informal Q&A, kind of the old style where I say, ask me anything. You can try to get me canceled if you want. Get me into trouble talking about politics or religion or something. But yeah, full disclosure too, we've had quite a few of these today. We went to the first tasting. I think we had maybe 4, and they're pretty generous with their tastings here. It's not like Canada. Canada gives you just a tiny little thing, but here in France, they give you the full glass. And so we did a few of those. And then we went on a lunch, and there was, I think, 7 pairings there. And now I've opened another bottle. So full disclosure, I've had a little too much, but yeah, here we go. So basically, I will stick around as long as we have light. It is 9 right now for me in the evening, and I think it gets dark about 9:50. So if there's any general questions, typically, of course, you all know if you've been tuning into my live streams, I typically present something early, and then I just answer all the questions. And the longer I stay, the more questions there tends to be. But today, let's just sit here. I'll drink, and you ask away. So I see there's a few people here. Yep, hit the like button for me. I am using a giant Burgundy glass, which I'm not super good with the wines. My wife is a sommelier, so she kind of teaches me a little bit. And, in the old days, of course, I would have just used the champagne flute. And I've been made aware that that is absolutely the wrong thing to do. You're supposed to use a regular wine glass, like a wider, at the very least, a white wine glass, if not a full red wine Burgundy glass. So, yeah, I'm definitely learning quickly, and it makes a huge difference. So, little tip from me to you: don't ever drink champagne out of a flute ever again. You won't get the proper smells. It tastes totally different. I know some people, I used to think that that was just crap marketing. They just say, oh, you have to drink this wine with this glass so that they can sell you more glasses. But turns out we did this tasting one time where they give you this same wine, but multiple different glasses. And so it's kind of flipped around. Usually you have same glass, multiple different wines. We did a glass tasting, and it is unbelievable the difference it makes. So it's not marketing. Glasses matter. There's a little tip that I've learned since I've been here. So, yeah, let's just see what's on everybody's mind. Uh-oh, I see one that I want to skip already. I see one about VTS options. Hopefully I can just kind of breeze past that one. What was the best red wine I've had? Here, I haven't drank any. We're in Champagne, so nothing but champagne. Best red wine I've ever had? I think Chateau Margaux is considered pretty good, and I've had that. I'm not sorry. I'm actually sitting outside. I don't know if it's fully clear on the camera whether I'm inside looking out or I'm actually right on the balcony. So, yeah, I think that's probably like the most expensive. I don't know if price, that's probably it. My favorite? I wouldn't know. I am a fan of Burgundy wines, though. Pinot Noir for me. And this actually is something also new that I learned is Pinot Noir, 100% Pinot Noir champagne. Color-wise, you cannot actually tell. I was actually expecting it to be darker, but turns out if you take the skin off, it is completely white underneath. I thought it was kind of a little bit red, but no. Yeah, everything Pinot Noir for me. All right. French wine too thin. It's like juice. I don't know. It's pretty good. I don't know if that's all the wine we've drank talking or me, but I am enjoying it. I used to hate champagne. Absolutely hated it. In fact, my wife, maybe third or fourth date or something, I bought a really expensive bottle of champagne. I think it was Veuve Clicquot or something, some, expensive version of their champagne. And I opened it, we had some, and I literally threw it away. I thought it was just rotten, disgusting. And since then, I haven't drank champagne. And now, just in the last, I don't know, 6 months or so, learned to appreciate it. But I don't know what this means. I haven't compared. I'm not nearly that good. I don't have a wide variety to compare to. I'm Canadian, so it's probably better than Canadian champagne. I can say that. All right, let me answer this. VIX options. I'm not sure if I fully committed to June, but obviously it won't be because we're in it and I'm on holiday. So yeah, same answer as always. I will try to get the videos edited as fast as I can and released. But I know there's a lot of people waiting, so it's a little bit callous of me to say, it doesn't really matter. But my point more is that investing takes place over multiple decades. So whether you start your options trading journey in, August, or whether you started in October, I mean, in the grand scheme of things, it is going to be a blip on the radar. What I'm trying to get people to look at is a very long-term process. And this is tough as somebody who, of course, is on the internet, is both an asset manager, but also trying to sell things online, which is very grifty and very, very quick. Everybody wants money today. And if it doesn't work for 2 weeks, they're out. It's just on to the next thing. This guy's a fraud. I really want to somehow try to communicate that this is something I'm trying to teach people that they can utilize for the rest of their life. I'm trying to get people to think retirement. If you can get your capital growing at roughly 1 to 1.5% per month on average long term. Obviously, it doesn't happen like clockwork. You don't just make 1.3, 1.5, 1.2, 1.3. It doesn't work that way. You're going to have losses and big winning months. But overall long term, if you can average somewhere around 1 to 1.5%, roughly 12 to 18% a year, if you do that for, a decade or two, you're absolutely going to hit all your retirement goals and targets. So, whether we start in a month or 3 months, hopefully everybody kind of forgives that if I can put together something decent. And also, of course, just heads up for anybody who is waiting for this course, it's not a one and done type thing. I am planning to add new strategies constantly and just have it as a rolling, learning, educational community over multiple years. It's going to feel new every few months. We're going to be off to a new strategy and learning new techniques. So it's not going to be just some set course that once you go through it, you're not going to see me anymore. It's going to be fully interactive for a very long time. So I want to do it right, basically. Okay, I'm about to dive into your 2-week introduction. Based upon what I've heard, you have a lot to explore. Yeah, decent amount. It'll keep you busy for a while. Will there be a roadmap to learning your stuff in the 2-week sampler period? Well, what I would say, let me just fire up the actual course. Sorry, I should have done that. We just came back from dinner. As you can see, I'm super casual today. For anybody who's actually brand new, first live stream, it's typically more structured than this, trust me. But yeah, today I'm technically on vacation. So let me see if I can show you this. Oh, I forgot to hit screen share. I guess I'm drunk. I am actually kind of drunk, but you didn't hear it from me. Okay, so when you arrive, of course, I can't tell you what to do, but I would prefer that you go through that. How am I going to actually see this on the front end? Because a lot of those courses you might not even be able to see. What have I done here? Let's go to the website, and hopefully I'm logged in there. I hope the only ones that show up are the ones that are actually live. But of course, you will get the welcome package. So I would definitely recommend you go through that first. That's what it's meant for. There's one per day. So 2-week free trial. There's just a short video, 5-10 minutes. Just watch that one every day. And then you would have a choice whether you want to navigate into Iron Condors. This is a 30 video. I'll just wait for the car to go by. 30 video Iron Condor course. So, once you watch all these videos, it's a good 5 hours of content at least. So that's a commitment. But if you're here to study the Iron Condors, then of course do that one. And then tactical volatility. One of our 4 strategies is tactical volatility. And I believe this course has roughly 15, 20 lessons in this one. Volatility product specific. So this is going to be talking about the vol ETPs, SVXY specifically, because that's the one we use. I do go through performance and stuff, but I also try to give lessons on how we trade these and why the short vol trade actually works. And then if you're still looking for more content, let me see. This strategy will be interesting for you, but it's not currently in our portfolio. But this is UVXY and VXX broken wing butterflies. And this course, for sure, I would read all of these articles. These won't take you very long, but there's 16 of them here. And then if you're really, there's about 12 videos here and maybe about 10 here. This one, interesting as well. This one's going to dive into the actual functioning of the volatility landscape as a whole. So if you really want to understand, for example, you've probably heard me or other people online a million times talking about the VIX futures term structure and what this all means. You definitely want to go through this course, watch all of these videos. There's only 10 or so. There's 8. So within less than an hour, you can figure that out. So I would say if you're new, obviously welcome. And welcome package first. That's no commitment at all. And then up to you. If you want to do an hour a day for 2 weeks, you could probably get through all the content. And yeah, it's my work. Obviously, I'm super biased. I think it's worth going through. I'm not going to tell you it's not, but yeah, there you go. Keep you busy. All right. It's crazy that SVIX is down since inception, especially if you went buy and hold. It is. Yeah. When we look at, and this is something that I've kind of been focusing on recently, trying to explain to people the differences between volatility and equities. I actually have an article I want to highlight just before I talk on other stuff. But a lot of people are under the impression that short volatility and basically long equities, the stock market, is the same thing. But it's not. So go through this. First of all, go through this article. It will explain why these are different positions. And then I've also on the website, I know these days almost everybody prefers video content. So go ahead on the website and watch this most recent video. Don't buy the dip until you watch this. I go through all of the reasons why short volatility is not just a proxy for the stock market. So if we look at the SPY, this looks like about a 4-year period here. You can see the SPY, it's actually doing fine. But to your point, the SVIX is not, right? This isn't great, right? It launched, I don't know when maybe sometime maybe 4 years ago, right around 4 years ago, the official launch. I've got the numbers all the way back to 2005. If anybody wants it, it's on the website. You can download my entire spreadsheet with all the volatility data in there. But yeah, it's rough, right? This is obviously not the same chart. If we go 2 years, you're going to see 2 charts that are completely different. SVIX cratering downward. SPY, equities, recovered almost fully. And so it is important for people to understand that there's a very good reason why we trade both of these in the same portfolio. You don't want to be that person that is doing the either or thing. I'll either trade equities or I will trade short volatility, assuming that these are directionally the same thing. They are not. They are actually quite different. Now, in a really stable market, a super long-term trend, that's a very loud helicopter. Hopefully you guys are not bothered by that. You see my microphone levels. Yeah, that's super loud. Wow. Let's take a break. Does everybody else have their wine? I've got mine. I'm ready. For as many questions as you've got, I'm ready to go. Come on. Maybe going on the balcony was a bad idea. Give it one more second. Once I see my levels dip down, this could be my last balcony live stream. So yeah, my point was that right around that sort of average choppy middle ground, you will see a lot of overlap between equities and short volatility. So say if you were to picture of course, I use the volatility barometer, somewhere around 30 to 60% market volatility, they will behave very similar. But below 30, you've got super low volatility, which represents really long trends. Short volatility will massively outperform the stock market during those periods. And then during rough patches, because you're factoring in the fact that the VIX futures won't actually be a pretty picture, right? Remember, they do function based on the VIX futures. If this VIX futures term structure is a mess, even if equities are going up, volatility products are not actually going to be able to budge, because you can see the front 2-month futures are actually fairly close to the VIX index. Now, it is expiration here, but even the contango tomorrow, starting Wednesday of the new cycle, it's still going to be in the low single digits. So short volatility will have a very difficult time performing well in this type of market. And we've actually been in this type of market for a very long time. It's basically since July 2021, 2024, right there where it hit its peak, and then all of this ugliness, stock market has wildly outperformed the short vol trade. So yeah, to your point, it's actually gotten all the way to this point where it's basically break even for buy and hold investors. Now, one of those issues, like I said, is the VIX futures term structure. If that's not steep contango with high roll yield, it's going to underperform. But the second reason is that you have to expect drawdowns are going to be significantly worse with short volatility, and drawdowns hurt your portfolio more than the gains help. So, of course, if you have multiple down 40 or 50% drawdowns, 50% drawdown, you need 100% after that just to get back to break even. So those two reasons are why short vol gets absolutely destroyed during an unstable market period. It's good to trade both of them at the same time. And yeah, for anybody who's crazy enough to think that buy and hold actually works, they have, rather rude awakening in the last several years to see that they are right back to the same spot. Even though the stock market is really knocking on the door of all-time highs, short volatility is nowhere close to all-time highs. So French wine lacks tannins, which makes wine thicker. Well, I suppose you might be talking about champagne, maybe, because in my rank amateur opinion, which is not worth a whole lot here, but obviously French red wines have, depending on which ones you're going for, can have strong tannins, right? Maybe I need to study more, but different regions and different types, I think you can have some pretty fantastic ones. You are Italian, correct me if I'm wrong. So yeah, you're going to absolutely say your wines are better. And next year, my wife and I will go to Italy, and I'll be doing a live stream on a balcony in Italy, and then I'll tell you, is Italian wine better? Could be. Could very well be. UVXY was trading at around the same level a year ago. Vol won't go down, really. Do you recall any other period in history where S&P was somewhat bullish, but vol is just nah? Yes, absolutely. Like I was just explaining, several periods. When you go through a time where it's tumultuous and you've got a lot of drawdowns, especially quick snap drawdowns, that's been the problem the last year, is that I think roughly 3 or 4 of the largest 20 volatility spikes in history have all happened in the last, say, 15 months. And the stock market doesn't always reflect that. The stock market really only digs in for a major crash when it's a significant, like multi-day extended, something major is happening. But when you get those really, really quick turnarounds, you can get the volatility ETPs, especially UVXY, to your question, that can, the UVXY can move 20 or 30%. S&P 500 might move 3%. Then maybe it recovers the next day. Volatility does not snap back the next day. So the UVXY just chunks down, or in this case up, but you're probably shorting it. And then you're way behind. Just one day, round trip, the S&P went down and then it went right back up. Volatility just chunked down and lost 20%, the short vol trade. So yeah, the Trump environment thus far, it's far too early to say, definitively, but thus far we can say that it is not an environment for the short vol trade. It's probably an environment where, to be perfectly honest, why is that helicopter circling my hotel? I don't know. I can see there's 3 of them. Are we going to war in Champagne, France? What is going on here? You can see in the reflection of the window, there's a bunch of helicopters. Yeah, it's a rough environment for the short vol trade. I'd say buckle up because Trump is extremely unpredictable. So if you follow me on Twitter at VolatilityVix, right there, I will occasionally tweet about politics, even though I try to stick to the rule that, look, no matter what is going on in the world, we still have to trade. I do sometimes get emails from people where they'll email and they'll say, well, this market's too unpredictable. I'm going to stop trading. I'm going to stop trading for 6 months to a year, and I'm going to come back and start again. And I just think, well, I mean, obviously do what you want, but none of us know what's going to happen next week or next month. So the moment you decide to stop trading because the market or because Trump or because we don't know. I mean, sometimes there's a war or a threat of a war and markets go up. I mean, it happens. And then sometimes a complete non-event craters the market. And so if we're the type of people that only trade during seemingly stable periods, there's no stable periods, right? It's one of those things that it also kind of reflects human nature and history, where we all think we are living in, the worst times or the most volatile times. We're just, poor us. We're living the last 20 years, worst time in history. We always think that, and the same applies to politics. People think, well, oh my God, has there ever been a time when we've been at war with this country and that country, and we've had tariffs and we've had inflation, and we've had debt? Has there ever been a time in history that this has been this? Yeah, many. Absolutely many. I mean, think of what the baby boomers went through, all of the major cataclysmic market events that were happening during their time, and they thought they were living in the worst. And traders who traded through, the late 80s, early 90s had to go through a 20% drawdown in a single day in, Black Monday, 1987. So the dot-com people thought they were in the worst environment possible. And then the financial crisis people thought it can't get any worse than this. And so I guess my general point is we just have to trade through it and trade a diversified portfolio. I'm not stopping trading short volatility because for all I know, Trump will be a boon for the economy. I mean, who knows whether he will do something here and then the stock markets will rocket to all-time highs. I really, really don't know. So I don't know whose question I answered there, but that's what happens when you have 12 drinks before a live stream. Do you like Europe or America better? Well, tough question because, I mean, I lived in the U.S. for 8 years. Of course, I am Canadian, so I will always have a relationship with America. But I do think that it's significantly declined, where you could say the same about Europe, but I don't stay here for very long. Like, I lived in the U.S. for 8 years, and it was great. I love the U.S. I've never lived in Europe. I just travel here and be a dumb tourist and do all the, wildly over-expensive tourist traps, and we just come for a month and then we duck out and we're gone. So I don't know what it's like to live here. Traveling, tourism, for sure, Europe. I mean, Europe's just as far as tourism and just the vibe when you come here, like I loved Norway. We loved Switzerland. We did the trains around the whole country. Every country I go to is incredible, but then I get to leave in a month. So I don't really know. I would say for sure traveling to Europe just excites me more. The US is like my home. I don't feel much when I travel the US. And I've lived in, I've lived across the entire country. I've probably lived in 8 different states. I've lived in, 12 to 13 different cities. I've lived in Washington State, California, Texas, Louisiana, Florida, New York. I've lived Arizona, New Mexico. I've lived in a wide variety. So for me, it's just, that's just home. Europe's another level. I love it here. I feel like I could move here, but then of course, ask a European, like ask somebody who lives in Paris if you can live in Paris. They'll probably say, not skip it. So we'll see. We'll be in Paris next week. Can one use VTS as a monthly income stream? I wish I had a big, Kramer red button, like the buzzer. No. Don't mean to break it to you. I know there's a lot of chatter online about the concept of monthly income. It doesn't exist, right? You just have to get that out of your head. There is no monthly income. There's no passive income. These words don't mean anything. So investing, there is no possible way to make it consistent enough to qualify as any type of steady income to live off of or to withdraw a certain amount every month and be comfortable. Investing always comes in waves. You'll have many months in a row where you make no money or you lose money, and then you'll have a few months where everything works perfectly and you'll make a whole bunch of money. The key is to not suffer drawdowns. The longer you can stay in the game and hang in there, even through small losses and bad months, if you can just hang in there, there's going to be a period that rewards you if you can hang in there. But the concept of monthly income, like for example, one of our strategies is iron condors. You go online enough, well, not even enough, 5 minutes on Twitter, you will see multiple people saying trading iron condors is just a monthly income strategy. No, it's not. It's absolutely not. You can set them up to maybe think that your monthly income, like I have a maximum gain of 7% of my capital and I've got really wide wings, so everything should be good. But trading doesn't work that way. You're going to get multiple losses. You're going to have periods where you have 4 losing iron condors in a row. And then where's the income? You just had 3 months straight where you didn't make anything. You actually lost for 4 months. So no, there's no income. There's no passive income. It's just, I would look at things with very long-term view, multiple year, preferably decade or longer. If that rate of return and that level of drawdowns acceptable for you, you are best to ignore the monthly noise and just find something that suits your overall risk tolerance and stick with it. Is chaos worthwhile to hold in a portfolio? Well, we have a strategy, all right? So we have 4 strategies. And this one here, the red one, strategic tail risk, our safety position is the chaos ETF. So what I would say is, no, you cannot hold chaos buy and hold long term. That would be just giving up a ton of gains during all of the times where it's not suitable, right? Not all ETFs, no matter how good it is, are suitable for all environments. This is why even the stock market, you cannot buy and hold the S&P 500 because there are times when it goes down 50%. So even stocks is only a hold roughly 60, 70% of the time. And then you have to exit to safety. Chaos is even worse. Chaos is going to have roughly 80% of the market where you just don't want to be holding something like that. So anything that isn't sort of 80% or higher volatility, what's the point, right? It is designed to perform well in crashes, perform decent, like not lose too much on a band of about 20% wider than the extreme crash, and then everything else is going to lose money. So when you're trading anything, you have to ask, when does this thing perform its best? Gold, for example. Can you buy and hold gold? I mean, of course a person could, but I can tell you right away that gold performs its best during about 60 to 90% market volatility. You don't need to hold gold for the rest. It's not going to perform well during those periods. But if you were in the habit of holding gold only when market volatility is elevated but not completely crashing and falling off a cliff, you can take out all the profit from gold while only holding it 30% of the time. Right? You can make the same long-term rate of return with gold as 100% buy and hold with just 30% of the market. So of course you would want to data mine all ETFs, all asset classes, and only hold them when they perform their best, right? You're not going to hold bonds during a super long, stable market period. Why would you? Stocks are going to destroy the bond market during those times. Maybe you would want to hold bonds during the highest 30% of volatility. Wouldn't want to be in stocks. Then gold, then utilities, real estate, the US dollar, oil, all of these things, we can figure out where they perform their best and only hold them during those periods. That's basically what my whole work is about. And it doesn't always work. It's not like gold only does well during that and always. Sometimes that's the worst period. But long term, right? Multiple years and a decade or longer, we can be very, very sure when they perform their best. All right. Here's one. The main strategy that I've been trading has been working like it should for years since going live, but I'm worried about robustness. It only works on ES Mini futures. What's your thoughts? Well, I don't know what the strategy is. I find it very bizarre it would only work on ES. That doesn't make any sense. Unless you are just using that as a general proxy to mean equities. That would make sense. But only ES? Like it wouldn't work on the Nasdaq? I don't know what that would mean. But I don't know your strategy. You already said it has worked and it's worked for years. I think that in itself makes it worthwhile to trade it in your account and to be fairly confident with it, especially if it's performed well. You know, did it perform well in 2023 and so far in 2025? If that's the case, you're on to something very good because these are two very different markets. So, yeah, I would say if it's performed well for multiple years in what is probably the hardest market we've experienced since the financial crisis, I'd say 2022 up until today, probably the most difficult market we've had in the last 20 years. And I would certainly say it's much more difficult than the financial crisis because then volatility went from 15 to 80 in a very orderly fashion. Bonds performed as they should during the financial crisis. Gold performed reasonably well. Everything was functional and stable and predictable ahead of time, right? It wouldn't have actually been that hard. So I think what we're seeing now is if your strategy is doing well in the last few years, I think you're onto something. So we're all, I mean, confidence comes from having a reason to be confident, right? What is that saying? Confidence doesn't come from screaming affirmations in the mirror. It comes from having, a stack of evidence that you are who you say you are, or your strategy is what you say it is. It doesn't come from I'm just going to will myself into confidence. It comes from exactly this. It's worked for years. Okay, now you have a stack of evidence that you're onto something. So, yeah, trade it. Keep going. I wouldn't ramp it up. I have a general rule that I just don't over allocate to anything, no matter how good it is. My volatility strategy, for example, was making over 30% a year for almost 10 years. And in the last 5 years, it hasn't, right? The short vol trade is been very difficult. It would have been a real mistake for me to say, wow, this thing's working incredibly well. Why don't I just put half my money in this or put 80% of my money in this? It's working better than anything else I've got. Let's just over allocate there. That would have been a catastrophic mistake because I don't know the future. So I still have to trade 10 or 15 different strategies and I have to be disciplined in my position sizing. Even if something's working brilliantly, you don't over allocate to it because it can end. Strategies that do extremely well, they can stop working. So don't over allocate, but I would say you've got enough evidence to know that you're doing fine. Would you join the Iran war if you were POTUS? That's a loaded question. The problem with answering political questions is I only get 3 minutes, but this is a conversation that would take hours, and it also takes an attentive audience. The reason that I tend not to talk about politics is not on my end. It's because in this environment, people have knee-jerk reactions to not actually listen to what you're saying. They're waiting for these key moments and these key words where you say something and they interpret it a certain way, and then they just, yep, see, he's that guy. He's that one. He's on that team. And then they don't listen to anything after that. So even if I spoke well enough to explain my point of view, the audience, it's on them to give me an opportunity and a little bit of line. Like you got to give people a little bit of leeway to explain things. But in this environment, people are so quick to you listen to 10 seconds, MAGA. You listen to 15 seconds, he says the wrong thing, this libtard. Listen to this liberal, That's what people do. So if I were to answer this question, and I'll answer it flat out. No, I wouldn't. In general, I am very anti-war. I'm certainly anti-regime change. I think that if you're going to try to convince me that you somehow think that this is going to be the time that regime change is going to work, like all the other times, we got a stack of evidence that this just doesn't work and it just produces more hate and more enemies and more borders all messed up and more sanctions, and this is the time. Like, this is the one that's finally going to work. This is going to take. I'd love to see it. I truly would love to see it. But what's probably going to end up happening is whatever we're doing with these skirmish slash potentially all out war, almost guaranteed it's going to make things worse. So would I enter that? No. I would probably have just a very hard line that it has to be diplomatic. And honestly, the solution to all of these problems is prosperity. That is the problem, is that if the United States wanted to fix Iran, for example, actually had an interest in fixing Gaza, for example, it doesn't come from bombs and regime change. It comes only one way. You need to make that region prosperous. You'd have to have the interest to do that, because the moment that you use sanctions, now you've destroyed any future potential for anybody living in that region to actually prosper. So the only solution then would be to lash out and make irrational, defensive, retaliatory decisions, which is what happens. And then everybody has a different clock. They're starting, this person thinks that this team's the right team because they're starting at 1968. And this person says that, no, this team's definitely correct. I mean, they're just fighting back. They're just defending themselves. But that person started their clock in 1989. So what game are we playing here? Let's just... The goal should be global universal prosperity. If we truly wanted to stop the global conflicts, it only happens with more equality and prosperity. It cannot happen by forcing people to do certain things, by holding them down, building them up, and they live next to each other, and somehow it's all going to work out. I can't believe we just bang our head into the same wall over and over again. And, it's the definition of insanity, doing the same thing over and over and expecting a different result. This will not be different this time, I can promise you. So long story short, no, I'm, 99% diplomacy. And unless I see a tank rolling like literally down this street, I'm not fighting back. That's not the way, in my opinion, right? People can have their own opinions. I just think that at some point we have to acknowledge that there is enough in this world for all of us. There really is. Anybody who says otherwise, just, they just want to keep their 17 houses and 40 supercars. But there's definitely enough for all of us. We need to work on global prosperity if we want to solve this. Unfortunately, our own individual countries can't even figure out domestic equality. We can't. The United States doesn't even have universal health care, one of the richest countries in the world. So I'm going to expect them to also just grant, wealth and riches to Iran. That's not going to happen. So I understand that this is just an idealistic, somewhat nonsensical take, but yeah, it's just massive, crippling inequality that makes people do the things that they do. And if we want to fix it, and look, rich people, flies in leave my champagne alone. Rich people, at some point, because the wealth inequality has gotten so bad that at some point, rich people are actually going to want to be giving their money away to make it a prosperous place. Because once it reaches a point, the world's not going to be safe for anybody to live in. And you can pretend that you can just go to your gated community and shut the world off. But if you want to be a part of society, you don't want to live somewhere where you're 500 times richer than your neighbors. It just, at some point, your life becomes too dangerous to be doing that. So, unimportant text. Yeah, at some point, the global goal should be closer equality. I'm not a pure socialist or anything. Don't get me wrong, but yeah, this is crazy. We're bombing and going to war with countries that are only trying to survive. It's just insane. Okay, did I get in trouble? How many people hate me? How many people called me MAGA? How many people called me a libtard because I answered that question? All right, thanks for the orientation. I appreciate this. And don't worry about being laid back. That shows the pro status. Am I too casual today? Just drinking and answering questions? I'm on vacation. All right, is this also for folks that are dipping their toe into retirement? It's a good question. I think what you're asking is, would the strategies, would my advice, everything I talk about, the options trading, does that apply equally to somebody who's 30 years old or somebody who's 68 years old? I would say yes. I personally, because I understand my own systems and my own strategies, I don't weight things based on some type of age related risk tolerance. My top priority is always drawdown reduction. And that applies for 25-year-olds as well. I've never really understood the concept of people just, they say you should risk a lot when you're young. I would say you should risk a lot as far as life experiences, as far as starting businesses, as far as traveling and perhaps making a few mistakes in your life. No problem with that. But when it comes to investing, we only have about 30 good years. And you really don't want to go, up and then lose it all and up and lose it all. Every time you do that, you lose not only your money, but you lose 3 more years and then you lose 5 more years. So I just think that everybody should start stable, drawdown reduction, risk management top priority if you're 28 years old or 65 years old. Obviously, if you're 65, you cannot afford drawdowns. But I don't think young people should be rolling the dice either. I think that what I do is directed at people who want to grow their accounts. And obviously, the way that I invest, it doesn't, well, nobody grows their account every single year. But what I do is 50-ish% of the time, it's just going to chop around and do nothing. But I have to be patient, not suffer the drawdowns, because I know my good periods are coming. I mean, it's just happened dozens and dozens of times. They're coming. And you can make your whole year's return in 2 months. So yeah, drawdown reduction. If you're 68 or 70, 79, VTS is still all about drawdown reduction as the primary goal. And after that, trying to ramp up the return. Oh, okay. How was the neighborhood tour in Dubai? Wondering which one you liked best for buying a property. So the last time I was in Dubai, for anybody who doesn't know me, I live about half the year in Dubai. I'm an official resident, tax resident of Dubai. No taxes for at least 2 more years. And what I did last time is I stayed in 6 different Airbnbs for 2 weeks each. I wanted to stay in, I've already stayed in multiple different areas, and I wanted to get all the other ones that I've never been to. So now I can comfortably say I've lived in every area of Dubai. And so I'll just give you like a top 3. So what I would say, if you want a super nice place to live, very high end, but not expensive, then Dubai Creek Harbor is fantastic. I was surprised how much I liked Dubai Creek Harbor. And it's actually going to be the next downtown. So it'll probably take them 10, 12 years. But once that happens, they'll have a tower. I don't know if it's going to be the same as the Burj, but it'll be a new tower. They'll have a mall that's bigger than the Dubai Mall right now, which is hard to even imagine. That thing is massive. And the new downtown will be nicer, more organized, and better than the old downtown. So I would say for investment and sort of cheaper living, but still super luxury, Dubai Creek Harbor, highly recommend. I mean, if you are into the touristy stuff where you're the type of person that likes to just go downstairs, walk outside, and you'll just see people and restaurants and bars and, all the Instagram people and, just the place, you could still go to Dubai Marina. It's still very cool. And then I would say maybe for future sort of upper end living, I mean, I like Emaar Beachfront, but it's not ready yet. I think once it's ready, they're sort of touting it as I don't know, sort of a Miami Beach style. It's obviously man-made. They just built this strip of like a peninsula that goes out and then a strip of land right in the middle of the ocean. And they're building about 20 towers on there, restaurants, full beach surrounding the whole thing. So white sandy beaches. In about 5 years, Emaar Beachfront will be nice. And then you could also, if you want to just pure investment and you don't actually want to live there, you just want to buy something and wait 10 years or wait 15 years, I would say either where the casino is going to be. I mean, how can that miss? Casinos are slammed, unless you're Trump in Atlantic City, of course. But, typically speaking, people manage casinos to profit. That would be a great place to invest. 10, 15 years from now, I would say you'd probably at least double or triple your money. And then the Damak Islands is really interesting to me, but that's going to take at least 10 years to even start to feel developed. So again, long term, I would buy in those areas. No matter what you do in Dubai, I would say oceanfront for sure, because there's just so much of it that at some point everybody's going to want that because it's the best. And there's enough of it that at least half the city is going to be oceanfront with little, islands and man-made places. And so if you're buying somewhere that isn't that, I don't think it's going to hold its value very well, because people are just going to be looking a mile down the road thinking, well, I mean, that's cheap too. Why don't I just live right on the beach? So yeah, do those new communities and wait 10 years. Okay, you're Chilean. Apologies. Well, I have enough wine information and knowledge to tell you that I know what you mean by the tannins now. If you're talking about Chilean wine, yeah, I do believe that you're talking about more full-bodied, probably heavier tannin wines. So yeah, agreed. French probably feels, especially my favorite Pinot Noir, probably feels very watered down for you. You're like, is this even wine? Yeah, I get it. Okay. When you did Voltrend, did you use any metric as to how to size the overlay? Or did you not care because it was generally opposite in direction? What would you recommend for market neutral overlays? So the vol trend, as a super basic primer here for everybody, is I essentially, because we know most of the time, as long as the VIX futures have significant roll yield, the volatility ETPs are going to decay downwards. So let's just imagine that this is typical. Obviously, you're going to get spikes here and there, but let's imagine this is typical. What I tend to do with that strategy, and there is a course on it. Do I still have the courses open? There is a course, as I pointed out. It is called Volatility Trend, and even though it's not currently in our portfolio, the course is still there, so you can learn everything about it there. But what I typically do is I sell broken wing butterflies on UVXY. So a broken wing butterfly on UVXY, 10 days out. Sorry, I just reset my Thinkorswim. So we are going to do a standard butterfly to start, and I will expand these. So let's say 2420. So this would be a standard UVXY butterfly, right? Break evens here. There is nothing wrong with this trade. Now, I would probably center it a little lower. So let's do 21, 23, 19. And the point is, the price is right here, right? So this is where the price currently is. And we know that under stable conditions, UVXY is going to decay a little bit. So you're trying to target, so roughly 1 week in advance, it's going to decay a little bit, and you're going to take your profit. There's nothing wrong with this trade as an initial setup. But what I do with it is, because... let's see if I'm not drunk enough to break the wrong wing. If you move one of them up, now you have a trade that loses no money here, but basically let's just call it double the money over here. And then if you do the other way, you've got a trade that transfers the risk from here. So now there's no upside volatility risk. If World War III happens, this trade can't lose money. But if it's totally stable and calm and the UVXY decays a massive amount, then all the risk is transferred down here. So these are the ones that I do. I break the wing that way, because if you think about what's happening, most of my portfolio is actually, most of the time, net long equities, net short vol, right? Let's say 70% of the time, my portfolio is positively correlated to the stock market. So if this trade decays too far, I mean, I want it to stop here. UVXY decays a little bit, so it is technically a quasi-short volatility trade. But if it decays a ton, I'm going to lose money. But obviously the point is that if that were to happen, the market would have been so stable that my SVXY would have made a bunch, my 2 times leveraged NASDAQ would have made a bunch, and my S&P 500 would have made a bunch. So do I really care that I had one straggler trade that actually ended up losing a bit of money? No, I don't actually care. If volatility spikes, these 3 strategies will probably lose money because I'll be in short vol and volatility spikes. So that's not good. Equities will lose money. But this thing can't lose any money. So it's not contributing anything to further losses. I'm not shorting volatility and just adding risk. I'm actually de-risking my portfolio, because if volatility spikes, this strategy can't lose money. If it goes down a ton, well, yeah, this trade will lose, but the overall portfolio will make a whole bunch, so I won't really care. That's the whole point of it. So now your question was, do I use any metrics to size the trade? I believe that's what you said. Sizing or strike selection? Drank too much. What did you say? Size the overlay. So here's what I would say. In general, with options trading, I like the 1%-ish per trade, because sometimes if I use 1% or 3% with iron condors, I use a stop loss, so it's technically about 1.5. I think that's fine. You can sustain 5 or 6 losses in a row, and it's not the end of the world. You never want to trade options to the point where if you get 2 or 3 losing trades, you're in real trouble. Sometimes people massively over allocate to iron condors, for example, because maybe they think it's income trading and, I'll make 10% a month, just like clockwork. Well, yeah, but then you'll lose 20% on a loss. And if you get 2 of those in a row, it's going to take you 4 years to recover the drawdown. So I like that 1 to 3% range. So with these, I do 0.5. That's just what I do. If you want to add more, what I would say is, instead of making each trade bigger, just add more frequency. With options trading in general, this is not a blanket statement, but applies most of the time. High trade frequency is almost always better than larger individual trades. So if you want more than 0.5 on the line, just every 2 or 3 days, look for a new entry and just mix it up with different, center points of where the UVXY was. And I would just ramp up your frequency, but I'd stick to 0.5. 1% maximum, because again, like, trading is trading, and you will get a streak where everything goes wrong. And it doesn't matter how good your strategy is, you're going to have 5 losing trades in a row. If you flip a coin for a while, you're going to have 7 losses in a row at some point, and you don't want that to crater your portfolio. So high trade frequency. When the price is different, the volatility is different, the time frame is different, the expirations are different, well, now you're reducing your exposure, and you're probably not going to get just a super long string of losses. At some point, some of those are going to turn to winners. So no, long way of saying I don't really use metrics to do that. It is basically a price style strategy where I just know that it decays, let's just say roughly 2 to 3% a week, give or take, and I just layer them as many as I can, knowing that I will only put these on when my portfolio is also allocated. So let's say, for example, short volatility strategy was in the VXZ or the gold, and then maybe this one is in utilities and this one is in chaos. Well, at that point, I have no net long equity exposure, so I can't afford to take the loss here, so I wouldn't put the trade on. But anytime I have net long portfolio, put on as many of these as you want. It kind of doesn't matter. I mean, obviously, you can imagine a point where you just overload your portfolio with a bunch of, basically, you don't want the UVXY to decay that far, but you'd have to have a lot of them on to get to that point. So no, I'd say just ramp up the trade frequency anytime possible and keep the allocation sizes as small as possible, and you should be good. So one thing I learned in the Champagne region here is that just because, I'm kind of an amateur, but just because I've heard of it does not mean that champagne is going to be good. I'll go into we've done already a lot of tasting. By the way, if you want to go to my Instagram, I'll just plug it real quick, just because I am not the type of person that, I tried to explain that I'm just not a social media guy. I'm not the type of person that shows off, or, I'm not going to flood the internet with a bunch of cool posts of me doing all these cool things, telling everybody that it's because I'm a genius trader, and obviously you should just dump all your money in everything I do because I've got a fancy car and I travel all the time. But if you do want to kind of track a little bit my life, I, of course, do have an Instagram, and I will put stuff on there. It's quite varied. This was an awesome one, by the way. This is Louis. This was amazing. I had never heard of this winery, but yeah, this was fantastic. Highly recommend. But yeah, running, I'm a runner. So this is Dubai Creek Harbor. Like a previous person asked me where I would recommend. This place here, super affordable. This is called Vita Creek Residences. Probably only costs about $500,000 to buy a place here. This is the pool. The gym's awesome. There's 6 restaurants downstairs. Pretty awesome. I was in Paris last year, of course. Wife is a wine sommelier, so you'll see a ton of wine-related things. But yeah, we travel. Norway last year. We were in Belgium last year. We were in Amsterdam last year. We went on a cruise. We do some cool stuff, but I'm not the type of person that's going to show these types of things. So I'll plug it on my live stream if you're interested. We went to the Barbie movie, and my wife and her sister dressed like Barbies. A lot of fun. Cats, running, golf. Of course, I'm a former professional golfer, so you might see a little bit of golf stuff mixed in here. Yeah, there you go. Switzerland. My mom caught the sun there. Cool. That's enough plugging. I'm not going to do it publicly because I'm just not that type of person. I like to let my work speak for itself. I don't want anybody to follow my community because I look like I make a bunch of money. I don't think that's a good way to pull on those emotional strings. But if you want to follow me on Instagram, there is a link on my website. I'll leave a link down in the description as well. And what I can actually probably even do is, I wonder if this is even possible. This would be a good learning experience for me. Is it possible that I comment on my own live stream? There you go. Very bottom of the chat. I just put it in there. Okay. Have you at some point worked a 9 to 5? Not really. I'm 50 years old, and I don't want to say I've never had a job, because when I was 17, I worked in a golf store for a couple weeks. But no, I've never had a job. Basically my job when I was 15, 16 years old, I started hustling people on the golf course. That's how I made my money. That's how I bought my car. That's how I financed my, school and where I lived and whatnot. Just gambling on the golf course. I was a member at private clubs, so I always had, I was surrounded by wealthy people and not great golfers. So I made a lot of money doing that. And then I turned professional in golf. So that was from age, 23-ish, something like that, all the way to 31. And that ended. And then from 31 to call it 37, like a good 6 years there, I was a full-time trader, which I highly discourage people from trying to do because it's highly stressful when you're pulling money out of your own trading account. You have a few bad months in a row and it's trouble. I didn't have very much money. I haven't had a whole lot of money in my life because I was a professional golfer and I was a struggling one. I was not on the PGA Tour making millions of dollars. I was sort of maybe half a stroke to one stroke outside looking in. So, I was a top golfer. I had a world ranking. I was, 600 in the world, but I wasn't 200 in the world. So I wasn't a millionaire. I haven't had money until fairly recently. So when I was full-time trading from about 31 to 37, I was trading on about 100 grand and I was pulling out 4,000 or 5,000 a month. So I had to be exceptionally good to just keep my head above water. And then it got to the point where it was too stressful. And then I started VTS 13 years ago. So that was about age 38, we'll call it. And for 13 years, I've been doing that. So does any of that qualify? Market's closed. Let's just check how gross today was. Does any of that sound like it was a job? Probably not, right? Nothing mainstream. I'm always kind of jealous. Stocks are down 0.8, so whatever. I love it here in Champaign. They ring the, I don't know if it's church bells, but there's some bell going off right now on the hours, and they, ding it 9 times, 10 times. It's pretty cool. No, unfortunately, I've always been a little bit jealous of that. I've always had this sort of romantic idea of putting on a suit and going to the office and hanging out with coworkers. I've never had a coworker. I'm kind of a loner that way. My whole life, I've been grinding on the golf course by myself, basically morning till night, till the sun goes down. And even I'd use the floodlights from the clubhouse restaurant. I actually had them direct one of them for me throughout the summer to just point to the putting green, and I would putt, in the dark. So I've always kind of just been alone. I've been by myself, and I've always been jealous of people who have jobs. So, if there's any asset managers out there that want to offer me some type of stable office work, and they don't mind if I tell you up front that I'm probably leaving in 2 years, then I'll give it a shot. I think that sounds great. Figure out where all the cool burrito spots at lunch or whatever it is, and a bunch of coworkers go out for drinks after. I've never had that. So everybody who's watching right now is thinking, yeah, that gets old quick. You don't want a 9 to 5 job, but I do, because I've never had one. Yeah, jealous, big time jealous. Have you considered Big Beautiful Bill? As a foreign from a rebel country, I will be punished. I think ditch the New York Stock Exchange if Rev, Revegan taxed. Um, Not sure what you mean. Are you implying that there's something in that? Actually, I do think that I've read a little bit about that. Honestly, I don't care. But macroeconomics, I don't actually care that much. We have to trade the market we have, not the one we want. So if the bill is good, if the bill is bad, I'm still trading my signals, my volatility metrics. Nothing really changes. But yeah, I think you're implying that there's something in there that they're clawing back foreign income and they're trying to basically claw back people from, maybe you are, certainly for Americans, there's only 3 countries in the world that tax foreign income. America's one of them. I hope that's not the case. I hope you don't have some type of influence by this. I think it's a terrible bill. I would not, I don't think there's anything good in it, to be honest. I think that I'm actually a little bit surprised it even passed, because it's not like there's some good things and then some things that kind of get dragged along with it. From my perspective, outside looking in, I don't see anything good with it. So we'll see. But it's certainly not big or beautiful. And it's not a bill yet either, because it won't pass. Why do you buy Berkshire? Isn't there a big active management risk, especially now Warren Buffett is leaving? So unfortunately, well, maybe not unfortunately, but we actually have recently made the switch back to the S&P 500. So maybe if you were to see this 3 days ago, this did say Berkshire Hathaway for about 2 weeks. This strategy has been going for, over a decade, and it's always been the S&P 500. But very recently, I've been doing some, research. If people want to see that research, I do write, I do write articles. And one of the articles will be talking about, let me see if my search function works, replacing S&P 500 with Berkshire Hathaway. Basically, when I do my research, I'm looking, as I mentioned to a previous question, I'm trying to decide what performs the best in certain volatility ranges, and I'm trying to skip the periods where it does poorly. So the S&P 500 does well at about 60% vol and below. This is fine for holding 70% of the time. And it turns out that Berkshire does actually outperform a little bit. But to your point, it is an individual stock. Technically, it is actively managed. It is going to have, earnings announcements. And the outperformance was technically mostly due to 2022. Berkshire did much better than the stock market during that maybe 1 year period. So very recently, I thought, you know what, just for diversification's sake, why don't we just try this for the rest of the year? And got to be honest, my email blew up. Absolutely flooded with emails about Berkshire. Questions just like this. Hey, doesn't it, sounds cool, looks great but isn't there risk here? And it's the same thing. It's basically the same. It's probably Berkshire Hathaway. I do a testing on a million different things, and Berkshire's one of the closer correlations to the stock market that you will find. And so it's kind of the same thing. Is it really worth the headache of answering 10 emails per day because we're trading Berkshire over SPY for a 0.5 advantage? Probably not. So yeah, it lasted a couple of weeks and we switched back. So no more Berkshire. Other people want to do it. And I'm going to write an article about this recently. Somebody reached out who is European. And apparently the MiFID II regulations that affect Europeans, where they can't buy US-based ETFs because the ETFs have to have a translation and what's called a KID document. And apparently he told me that he has no issue whatsoever trading Berkshire. So he can't trade the SPY, but he can trade Berkshire. So I will make sure that I write an article soon saying, hey, if you're in the European Economic Area, if you're in one of those countries that is affected by the MiFID II, you might want to consider finding super highly correlated individual stocks that pay or that have low fees, low trading fees. Berkshire should be really, really high on your list. So it could be good for some people, but officially we have gone back. How's the picture? Because it's dark here. Where I am, it's dark, but I see, I came prepared with a light, and I came prepared with this. Yeah, there we go. I'm staying up late tonight, and I'm drinking more. I don't drink much at all, so I don't mind drinking on a live stream. It's not like I'm a drunk. I don't have a problem. I barely drink. I only drink with my wife, and it's only wine. And so don't think I'm some drunk that I can't even sit through an hour live stream without a drink next to me. I'm not Elon Musk. Just kidding. Kind of not kidding, but kidding. Okay. Can you just buy VIX futures and add to the position to offset negative roll yield until a spike? No, because you're going to be bleeding capital. The whole point of the VIX futures is, unfortunately, when people look at it on a long-term chart, they don't really piece together what's actually happening. But the VIX futures are literally expiring and dropping off the board. So one thing that confuses people a lot is that they think that they'll look at it on a long-term chart and they'll say, oh, the front month VX future was here. And so if there's a spike, it's, surely it's going to get back to where it was, say, pick the date, like 6 months ago, a year ago. And they think it's going to trade like a stock it's going to hit an all-time high again or something like that. But the VIX futures are dropping off the board constantly. So basically the vehicle that caused it to go down is gone forever. There is no all-time high. There is no all-time low. There is no anchoring to a previous point. It's just gone and gone forever. So if you're going to be in the habit of buying the VIX futures, and basically what it sounds like, unless I just read that completely wrong, somewhat quasi dollar cost averaging your position, you're just going to be bleeding an enormous amount of capital. And when you finally get that big spike, the big payoff, you're not going to make nearly as much on that payoff as you have paid in to this steadily bleeding insurance product, because that's what the VIX futures are. That's what long volatility is. That's what house insurance is. You just pay and pay and pay for years, and maybe one day it'll pay off, but probably that big payoff won't even offset what you paid into the premiums along the way. So no, you can't do this. You can't just essentially dollar cost average long volatility and just wait for the big spike. Unfortunately, you're going to have some type of timing system. For me personally, that does mean that we wait for high volatility, and we only get into long volatility when there is a serious reason to do that. We're talking about high 97, 98th percentile of volatility levels. If the volatility barometer gets way up here, clearly something is melting the market down. VIX futures are going to be in super backwardation, which is going to be a tailwind for the long volatility. Mathematically speaking, even if stocks are flat, this would continue to go up. And that's the time that it's most beneficial. Yes, it is true. You will miss that initial pop, but far, far better to not bleed down what would amount to hundreds of percent losses, right? Because again, it's resetting over and over and over again. So there is no bottom. It's a bottomless pit of negative premium drag over and over. No, you can't do that. Hopefully I read your question right. From 2020 till now, day trading strategy, closing by end of day, and doesn't work well on other index futures. Interesting, that second part. I don't know why that would be. But, I mean, if it's been working well since 2020, you know the answer. That is a plenty robust strategy to consider it a success. It's not we, it's Israel. I probably got myself into trouble talking about that. Unfortunately, my friend, that'll get me into trouble talking about that as well, but it kind of is we. It is we. One thing that does bother me about the world a little bit these days is people are very quick to forget what is in our own backyard. I don't really know how to say this eloquently and avoid getting in trouble, but boy, it's not just Americans, but Americans are good at it. Telling other countries that they should or shouldn't do this, or you're guilty of human rights violations, or you've been doing this. Really, we're doing that? Standing in the United States, we are telling other people that they should be doing. I think people should, turn that around and point it at themselves sometimes. There's, I get it all the time. I left Canada 25 years ago. I moved to Taiwan. I've lived there for 17 years. I have recently moved to Dubai. I get tons of people telling me I'm a traitor to my country and Dubai's guilty of human rights violations. And, it seems like a great place to me. But let's be serious. All of our countries, none of our hands are clean in any of this. So you might be able to split hairs and say some places are a little bit worse than others, but we are all we are all guilty in this madness. Yeah. So let's on a positive note, let's leave it there. I don't know how many more. There's a few more questions. Let me see if I can just scroll. Here's one that looks short-ish. Oh, I missed one. In strategic tail risk, you use IYR real estate. Yes. Let me just point to it for anybody who doesn't know what strategic tail risk is. Our safety position, I'm putting that in air quotes. You can't see me. Safety IYR real estate. It works very, very well in this band. Now, IYR isn't better than the stock market. It's certainly better than chaos buy and hold, but it's not actually one of the top long-term buy and hold performers. Drawdowns are pretty large, but we can isolate the best periods to hold it. Again, getting back to that point where we don't have to hold it all the time. We can just target what is probabilistically speaking going to be its better performing time. Sometimes we just miss it completely and we get hammered, but maybe not hammered, but we have losing periods as well. But yeah, in about a 30% band of mid to high, works good. Let's keep going. What is the thought process of going into a real estate fund? Is it to accommodate possible Fed cuts upon vol spikes? So this is a really good question. It's actually not based on what you think. You would probably assume that it's some macro analysis, like I'm going into real estate because I think interest rates are going to do this and that's going to do that to the stock market. And it's not. It's not all out 100% data mining, but a lot of it is I am just looking for something that performs really well in this band. This strategy is an S&P 500 strategy, right? 70% of the time it's in the stock market. About 5.5% of the time it's going to be in the chaos ETF. Before it was long volatility. Now it's chaos. I can't wait to that hit too. Hopefully, not hopefully, knock wood. I don't want anybody to get hurt. Let's stop the madness. But if the world does fall apart here, I'm actually quite curious to see what happens to chaos. I'm looking forward to the performance there because I think it'll be quite good. This is relatively new. It used to be long volatility. But yeah, IYR is in there. I wouldn't say entirely as a parking spot, but it's kind of the same thing with gold. It's not some macro analysis on my end that I think gold is going to do awesome because of all these global, geopolitical reasons or anything. It's just a parking spot when it's too risky to be in short volatility. Gold is the best performer by far, well, utilities as well, but we always use utilities here. So gold and utilities are awesome. IYR's third place. It is actually one of the better safety positions. It's far better than bonds. It's far better than other things. So yeah, I hesitate a little bit to call it a pure parking spot for capital when we're not in the stock market, but kind of. Hopefully you get my drift there. It's not some broad macro analysis. It's just what can I put my money in that's going to give me a positive return, that's going to have a controllable drawdown during a elevated volatility range. And IYR is a great performer in that range. So there it is. Okay. It's interesting. Please remove this GIF that's showing the tech robot animation on your course site. It looks unprofessional. One thing I will say is, so what he's getting at is this. Yeah, I designed my own website and I understand it looks like a 12-year-old designed this website. Like it's nothing like what other people's websites look like. If anybody in my space, right, that's selling anything online, isn't there supposed to be a bunch of testimonials and there's supposed to be some type of emotional string pulling, like here's how much money you can make, and shouldn't I be showing pictures of houses and cars, and here's how much better your life is going to be if you just listen to this guy, right? I understand that's what it's supposed to be, but I designed this myself. I designed it to be completely unemotional. I'm not trying to convince anything to do anything. I don't want people buying into VTS because they think they're going to double their money in 6 months. I don't want those types of people following me. So getting back to the original point, that's my design. I will take responsibility for that. That's not like built into the website. and agree to disagree. I think it's kind of cool. It gives color, right? All I needed was separation from the top of the page. So technically I could put anything there, but come on, little robot with like wavy things. Looks pretty cool to me. I might keep it. I'll give it some consideration though. Yeah, the main point is that I just, as you know, I'm not salesman at all. Like I don't believe in that. I know I'd make more money if I did that and if I adopted that style, but I do fine. I could do a lot more, but I'm, as I've always said, I'm kind of a minimalist. My wife isn't, so I have to work pretty hard to keep up, but I am a minimalist, so I don't need more. I don't need to be all over Twitter playing the grifter game. I don't do that. Any capital allocation aside stock and options futures? Nope, nothing. VTS options. All my work, everything you see is just my portfolio. I never create anything and present anything that I'm not personally trading. I don't create things that I think other people will find cool and therefore pay me extra money. I only present and trade what I personally have my money in. So you could call it a roughly 50-50 portfolio at this point, 50% tactical rotation, as you see here. Roughly, I mean, it doesn't work out exactly, I hope you understand, but roughly 50% of my portfolio is this stuff. And then the other 50% would be discretionary options trading, all of my VTS options strategies. And that's it. I don't do anything else. So there's nothing I'm like, strategies that I don't want to reveal to other people. I'm just sharing my portfolio. That's how this all started for me. I didn't start a business to start a business. I was doing this, posting my results, writing articles just for free. Like I was a full-time trader. I was just doing that. And then a bunch of people started, not a bunch of people, that's a little bit presumptuous. There was a few people, like, 20 or 30 people who were following my work, and they thought, oh, this is pretty cool. Maybe if I just send you $50 a month, you can send me the trades the same day you take them. And I thought, well, I mean, I'm just trading my own capital. I mean, sure, I can do that. So I started doing that. And honestly, that's what I still do today. It's just more than 50 people. It's a lot of people at this point, but that's all it is. It's just me sharing my portfolio positions the day I take them. These are all my strategies. So yeah, nothing more, nothing less, if that answers your question. Everything that you see will be what is in VTS work and nothing more. That's like just your opinion, man. Yeah, that's funny. Sometimes I feel like I shouldn't share opinions because, like I said, people are just going to misunderstand. And I'm sure I said something that this is going to trigger some people. And hopefully, as I always say, if we met in person, I guarantee you would get along. Even if I say something that sounds like I'm a libtard or I sound like I'm a hardcore MAGA guy and you hate me because I'm not the type that you want, trust me, if we go golfing, we'd be friends. If we go to the bar and have a drink, we'd be friends. So this whole online thing that we're doing, this whole experiment where you're either on this team or that team and you can't be friends, it's absolute garbage. If you go to any company, I'm sure the people who voted red and the people who voted blue have far more in common with each other as the workers than they ever will with the CEO, regardless of who the CEO voted for. You and I will always have more in common with each other. If you are a Republican and I'm a Democrat, not saying I am, but let's just say we both have more in common with each other than we ever will with the leader of our own, political party. So it's classism. That's what it is. All this red, blue, black, white, it's nonsense. It's just all so we don't direct our hate to where it should go. The people who are hoarding and screwing us over at the top. That's what this is all about. It's what it's always been about. The elites, puppet master playing the strings, making us all hate each other. And now they have this incredible technology and algorithms to make us hate each other. It's working brilliantly because now nobody knows where to point their anger. They just point at their neighbor. I mean, that guy voted the wrong party and it's their fault, and pointed at the brown people because we don't want them in our country. That's what's going on. But the real problem is wealth inequality and elites at the top. And I don't get invited to the backdoor cool meetings, so I'm not one of them and I never will be. So whoever you voted for, whatever I said today, if you disagree, we're still friends. We're still on the same team, even though it might appear like we may have voted for somebody different. We're on the same team. Okay. It's interesting. At me. Got your reply email late last week with respect to my data ask. Okay. I thought your picture and name. There you go. Have you relooked at the data and think I understand it now? Have detailed info for you. Hold it until you're back from vacation or send. I mean, if you send it, it might sit in the inbox, but if you're ready to send something, I might take a peek at it. I'm not avoiding it. I think what happened with our communication, this is a convo between me and one person, so this isn't interesting to anybody. But I think what you didn't notice is that I wanted to make the dates match up. So I gave you all 3 strategies going back to inception, but I can actually, even though tactical volatility officially launched with VTS, it was one of the original 3 strategies, launched January 1st, 2012 with live capital. I can actually, because it's 100% systematic, I can just drag this one back. And so I sent you all the way back to 2006 just because I thought that would be your next follow-up question. Like, hey, wouldn't it be interesting if you showed me what happened in the financial crisis? So I kind of just went ahead and did that for you anyway. I dragged the back test back. But unfortunately, some of the volatility metrics that this strategy uses are not available going back that far. And it's the same situation here. So unfortunately, I can only drag this one back maybe to, robustly, probably just mid 2011. And this one actually can only go back to 2012. But this one, everything that's used within these signals can go back to 2006. So I sent you that. But probably on the spreadsheet, it appeared like I just gave you one strategy when actually if you scroll down, there was all 3. I think that's what happened. I'm guessing that's what happened. But yeah, send whatever you've got. I will peek at it in between wine tastings and then dive into it in 2 weeks. All right. What's this? That's the problem. I don't do well with any stick and ball, golf included. That sounds like an interesting conversation. I jumped halfway in. I don't know what that means. Duke. This is the last one that I'm seeing. Wonder why my question was skipped. Let me scroll through and find Duke. So, I mean, before I was even going to make an excuse, my system here doesn't show every question. It probably shows about 80% of them, but I think this is it. My strategy is poor man covered call with Tesla and NVIDIA in bear market. Your thoughts on continue to sell calls deep in the money and wait for leaps to move up? Well, I mean, anything undefined, if I don't know what your really strategy is talking about here. Are you just selling a bunch of short dated stuff and waiting for your long dated stuff to basically cover as you're hedging? Anything naked at all, I'm going to say is probably inefficient because, of course, it's just very capital inefficient. So I would find ways to define everything, and then you'll probably make more money, and you will also be safer as well. But sounds interesting. Come back next time and maybe explain. Give me an example. Give me an example of a Tesla or NVIDIA trade that you are doing, and we'll take a look at it. I'll look at the software, load up the trade, and we'll see. It's probably good if you've been doing it for a while. This is the thing. Like, obviously, there are people who know a lot. There are people who know a little, but there are no real experts. And so, yeah, you could very well have something going here. I'd love to see an actual example with strikes and expirations, and let's go through it. So till next time, like I said, I'm here in France with a very flexible schedule. So typically I try to stay to Fridays, but I can't commit to that because this Friday, my wife and I might be somewhere we didn't expect we were going to end up. So cheers. Hopefully maybe a few of you join me for some drinks. But yeah, until next time, hopefully still in the wine region. See you next time.